Thank you. So at our first meeting, we were asked just to hear a little bit about investment strategy and stuff. But what we have to remember, we have Tom Galanka here, who is the chair of VPIC, the new VPIC commission as of 2 days ago, right?
Yeah.
Yeah. So to talk to us a little bit about investment strategy, but remember, we are not the investment committee. We are not going to do investments. We're not going to make recommendations to them to do investments. That's a separate group. We are figuring out how we spend their investments. So, all right. So with that, Tom, do you want to, and I will say Tom was very helpful to us during the session in both the House, I believe, and in the Senate. Thank you.
Thank you. Well, welcome everyone, and I want to applaud you for taking this on. This is a tremendous effort for, particularly just the time commitment, but also the magnitude that you're trying to accomplish. I'll give you a little bit about my history. I've been on the VPIC, I was appointed by the governor to VEMRS. So I came to the system through my VEMRS relationship. I was a city council member here in Montpelier. From that, they elected me chair back in 2016 to the VPIC. And at that point, VPIC, we probably had about 3 billion, 2.5, 3 billion or so in assets. And what it is, it's the collection, obviously, of the teachers, employees, and municipal monies pooled for investment purposes. And we really didn't have much of an internal staff just run through the state treasurer. So what we've done, and really to explain the investment philosophy of VPIC, is that we've tried to simplify it, make sure we know exactly what we own. We've indexed where we could to reduce fees. We try to underwrite everything so we can basically avoid mistakes. A prime example is 2 years ago, from years ago, we had owned this Allianz Structured Alpha product. It sounds complicated. If people remember last year at COVID, it blew up, and Blue Cross Blue Shield here in Vermont had a significant amount. And I know that hit the papers where they lost about 60 or 70% of their pension fund because they were in it. We had sold that a couple of years before. So it's this part of process of underwriting everything, making sure that if somebody asked me, well, what do you own and why do you own it? We could, as a staff, we could basically say, this is why we have it. So we also combine that with making sure that we have enough liquidity. Obviously with the teachers fund needing about $15 million per month to cover benefit payments, we need to have adequate liquidity on hand. Now we use a lot of the cash flow that comes in from the legislature that pays us every July. So net, it's about even at this point, particularly with the overfunding. But if we didn't have that, that would be a significant drag on earnings. So through that process, we've professionalized the internal staff working through the treasurer's office, and Beth and the treasurer's staff have been tremendously helpful in this process. We've brought in a chief investment officer to help us interact better with our investment consultants. We've actually switched out our investment consulting group over the past couple of years. And we've probably turned over the whole portfolio over the past 5 years by every single investment. And we have a whole new portfolio here. I've given you information just for reference. I don't really need to read it all or go through, but I can give you the highlights. I know Chris had highlighted, the first page is this nice little graph of what we're looking at. Chris gives you the nice smooth method of a 5-year smooth average of what it actually does. And you'll hear 7% rate of return and you think that's in the bank. But in reality, goes back to 83, as high as 38%, as low as negative 19%. And this current year, we should end around 23%, give or take 0.5% or so. The data I've given you is through May 31st. We just ended the fiscal year on June 30th. It was a good month. I assume it would be slightly up, maybe up to another percent end of June. Plus, we also get the private equity component, which should kick in as a valuation over the next 2 months, which should kick it up a little bit more. So I'm really optimistic that this year we will end on an annual basis one of the best years since '85. That being said, you can see this chart that we've had negative numbers, and it's a lot harder to, if compounding. When we have a big loss, it takes twice as much effort to get back out of that hole. So it's not as smooth as the 7% that you read and hear about. So it's very endpoint dependent, but I wanted you to have this just to see because it gives you a perspective on what we're dealing with in regards to the portfolio. In regards to, this is what we see on a monthly basis. So you get this monthly investment portfolio report from RVK, and you can kind of see on page, probably the best page is their summary page on page 4. And it basically breaks down how we've allocated the portfolio. We look at it in 3 different buckets, one of which is growth assets, assets that are going to buy, the growth for the portfolio for future years. There's the downside hedging portfolio. And then there's some inflation protection aspects of the portfolio. And the 3 components combined to help us manage this. You'll see that last July 1st, we were at 4.5 billion. We had net outflows of cash of about 39 million. We had gains this year of a little over $1 billion. That should maybe be $1.1 billion if June ended as I think it did. So we have about 5.6 or $5.7 billion in assets right now in the trust. And so that will affect your valuations going forward. And there will be some unrealized gains that will flow through the system over the next 5 years. And so there is that component. Now, next year we could be down 20% and you could have unrealized losses that flow through it as well. But I pointed out that it's an important component of valuation and funding that I think you really need to understand that market value to me is more important than actuarial value. Now, Beth may disagree with me in terms of budgeting, but I think market value can help lead for better decision making, particularly from the legislature, because you look at some of these decisions that you may make with funding or with when dollars go in, and it may be 2 or 3 years late in regards to a market timing approach. If you look, for example, back in 08, 09, markets were down 20%. You'd think that's a great time to be throwing money into the market, and that would have benefited. But a smooth number was really actually up for that year. I think it was up about 2%. So the actuarial value would have underfunded it to some extent at the times when you really want to be throwing money into it. Conversely, times like this, you're smoothing numbers that were relatively poor in the past couple of years and only taking 25% of this year or 20% of this year. And so you may be theoretically overfunding it if you throw a lot of money at it right now. And so I think timing perspectives may be something you want to consider. I know other states have looked at smoothing and they've thrown it out. I know South Dakota doesn't use smoothing, but smoothing helps with budgeting. And so I think regardless, I think the legislature needs to know about, well, what's the market value? What's the smooth value? What's the implications for when you throw money in? I know we get the money every July. Well, maybe we need to space that out over 12 months and not necessarily put it all at once. So I don't know if I threw too much at you, but that's kind of where we're at. I think right now we have nine board members and myself as chair and a number of alternates for each of the respective interest groups. Over the next couple of years, I imagine we're just going to refine as an independent entity, refine more the independent nature of it with possibly increase hiring, strategic hiring to really take more ownership of this pension, not let Wall Street or Wall Street firms really dictate what we want to buy or should buy, and really make it work for the state of Vermont. We'll do our best. I think we're doing a relatively good job over the past number of years. If you go to page 6, and I'll highlight this number because since it is endpoint sensitive, I'll throw it out there. 5 years, we've averaged 10.28%. 3 years, we've annualized 10.56%, and 1 year number, we've annualized about 24.7%. Now, come back to me when the markets drop 20%, and these numbers may be very different, but I'll take ownership of that since I took over to be chair 5 years ago. But that being said, I think we try to do our best to maximize return and also minimize risk, because we understand that we need to come up with that $15 million every month. And we know that people rely on these funds for their pension benefits, 20, 30, 40 years from now. We want to make sure that it's sustainable. Does it need to be 100% funded? Probably not. Would 90 or 80% be significantly better? Yes. And I think that from a goals perspective, I'd try to gear towards that, because I think a very healthy plan would be somewhere in the 85 to 95% range. And you can really, plan well there. I know Canadian pensions are much better funded because they have trigger points. When it gets below a certain level, there has to be a mandated plan to get back into compliance. Corporate plans require significantly lower rate of return assumptions, which is driving many of the corporations to drop their pension plans. There's some happy medium there here for state pensions, and we're willing as VPIC to help work through this. We won't solve the whole problem, I think, but we will be a big component, and we'll do our best to help make sure that we're well diversified, we're covered, and we can help you with whatever needs to go forward. Through the VEMR side, I understood the benefits of incrementally increasing and shared responsibility between employee and employer contribution rates. And I think that has worked well for VEMRs, but that's one option, going forward. So I'll open up to any questions and wish you good luck.
I do have some questions that are probably more informational than anything, but
Sure.
just it'll kind of help us understand how you do business. When you're going to redeem, as you said, right now, the teacher's pension needs about $15 million a month more than what you have available, perhaps. But where would those redemptions come from? Are you selling bonds or?
Well, we have some cash flow that comes in from whether it's dividend or interest, or we have redemptions in some of our private equity. We also have calls that happen with our private equity that's increasing. So we have a pacing strategy for cash flow in that regard. So we have designated liquidity pools, whether it's basically index funds, whether it's index mutual fund, index equity funds, or whether it's index bond funds. So what we'll do is we'll use those as opportunities to rebalance. So where we're overweighted, we'll take some money from there. Where we're underweighted, we'll leave alone.
How often do you rebalance?
Usually they do it quarterly, but they may need more in certain months, particularly if it's later in the year. And because you don't have to as much in, obviously July when we get the big state deposit, you don't really have to as much because you can manage the cash flows that way and rebalance it. The investment team led by Eric Henry, and it's really three team members, Katie and Andy, and they're great employees here for the state of Vermont. I just shouting out to them and their work here, but they manage those cash flows. We've invested in a new software package, which is called Matrix, which is going to help us manage more of the internal cash flows and internal processes that they've put together for exactly that feature. It's supposed to go online in a couple months, so I'm looking forward to that. It'll give us a better look through too, as well as from our money managers.
And you mentioned on you get the big lump sum, 1st of July, give or take. What about the employee contributions that come out of their paychecks? Do those go to you on a monthly basis, or?
That I'd have to ask Michael. They don't.
Are they?
They go.
We just get our monthly.
Are they held?
No, they go as we get them.
Yeah.
Okay. So they are forwarded to VPIC for. Okay. And then the only other question that I have, and it's a big one. If you go back 10 years, cash flow, employer plus employee minus what we have to pay for retirement benefits, it's roughly a negative 30 million. But the positive side I didn't talk about was the investment earnings.
Yeah.
So probably most years that's going to be a positive cash flow. And so my question is, and there's no way of being sure, is this demographics? Is this the problem? Is it, are we missing? I want to make sure we don't miss something.
Well, it's a good point. At one point, does it become where the liquidity needs, and that comes to a question to VPIC is, do we need to change our asset allocation strategy to really address, the different liquidity issues that may come up with teachers in particular? We're not there yet. So we're managing it. I pointed that out. The net cash flow last year was about 33 million. Yeah. And so, if you take out what the state put in extra, obviously that's a significant chunk of money. We did have investment gains of $1 billion, and we've that goes a long way, to cover our cash flow need for this year. We're not at that point in terms of cash flow needs. We do have liquidity studies that we look at every year, and we will have those reports go to the legislature. So we will monitor, and the actuaries are tremendous help in that area where they can help us understand the liquidity needs, particularly on a plan by plan basis, because the teachers are different from the munis and munis can withstand more risk. And should we have a different asset allocation strategy for them versus just a pool of trust? And those are the type of questions that we're grappling with right now. And I think we have the tools now to be able to do that in a better way.
So do you, and I'm sorry, but this probably will be one of my final questions, if not final. Are you fairly sure that it's the demographics issue that has been finally studied and that caused this workforce really to be impaneled, that has caused the negative fund balance, or not negative fund balance, but the decrease in funded ratio? Even though we've shown a positive cash balance, it may not have been a whole lot, but the positive cash balance over most of the last 10 years.
Well, I think you see it through Chris's presentation, it's accelerating benefits, outstripping gains, and sort of that widening difference between the two. There's a lot of pieces that go to it. And I think you just have to look at that chart and see which were the components of that. Investment returns and artificially high rate of return assumptions did hurt, yes, particularly when you're investing at a time frame that was a little bit late to the game after the 08, 09 period. Were we overly conservative coming out of the Great Recession? Possibly. Looking back, trying to do a postmortem of how was it invested. I think every pension board and every investment committee I've been at had done very well at looking at that. But, you're looking at hindsight right now and saying, should we have bought it 09, instead of been 60-40? Should we have accelerated? I don't know. I think the demographic change, aging retirees has hurt. I think employee contributions, comparing that to other states would be very helpful, seeing how other states look at that versus employer contributions, looking at shared responsibility if things don't work out. I'd hate to see you push out the amortization schedule because I think it brings in discipline. But in a bad year, could that be a stopgap? Definitely, and particularly for budgeting purposes. But, there's a lot of levers you can pull. I don't think it's going to be one. I think it's going to be a multiple of 5 or 6, that get to the best way of approaching this.
Madam Chair, you just brought up a question I'd like to ask. In a bad year, would you look at a layered amortization schedule instead of pushing out the amortization schedule?
You could do anything you want, and I think it does give you the flexibility there. I like, compare it to like a 15-year mortgage versus a 30-year mortgage. Obviously, you're paying off more principal when you get down to 15 years or less. We're almost there. I'd love to see us get below 15-year amortization before we do that.
But if you take out a home equity line of credit on top of it, then.
Well, that's true.
Okay, thank you.
Question?
You sure?
Andrew?
Are there any other questions?
Drink your seltzer, okay?
No, that was a great set of questions, Peter.
Yeah,
Thank you.
Yeah, thank you. Andrew?
Just 2 information questions. So is RVK the company that is managing?
RVK is our independent investment consultant that we've hired, and we just hired them we went through a big RFP last September, October, and we brought them online at that point. We used to work with New England Pension Consultants. They're independent, so they help advise us. They vet our investment managers. They do all our performance reporting, and they provide us with all of the background for basically they're extension of our staff. So we have 3 internal staff that work with RVK, but they don't manage it on a discretionary basis. That's the sole purview of the investment committee.
Okay. So there's not like one like Prudential or Vanguard that's overseeing this?
No, it's the investment committee. And we do have a chief investment officer here at the state of Vermont that we hired he's worked for us for about 2.5 years.
Okay.
He came to us from the Hershey Trust. He ran the Hershey pool of funds.
And so since then, there's no company like that. We're not paying any sort of asset-based fees, just the fees on the different funds.
Just the fees on the different funds.
Okay.
Now, the different fees we have, obviously, actuaries, we pay the consultants, we pay Bloomberg, for some of our services. Mm-hmm. And so we do have some fees that are attached in, but that was one of our primary focuses about 5 years ago, really look at fees and understanding what we're paying for. And back in 16, I think we were paying all-in fees about 68 basis points. Now we're down to maybe about 41, 42 basis points. So we've lowered those fees as well as increased assets by a significant amount. But the fees we look at that annually.
Yep. Okay.
Eric?
Tom, you mentioned the smoothing method and, its relationship to ideal market timing. It seemed like, was it South Dakota was kind of an outlier there in getting rid of it?
Well, it jumped out at me that they got rid of it. I don't know if they're an outlier or if there's others. I haven't really looked into other states in regards to their smoothing methodology. That is a question I'd ask the actuaries. What are the studies there? Is there a relationship between smoothing methodologies and investment rate of return? Are you timing it poorly because you're smoothing on either end, buying high and selling low? We're not putting in enough, in times when the markets are low. I don't know that answer, but I think it's an interesting question to ask.
Because I was going to, my next question was going to be, is there a group of states that are maybe in the middle between no smoothing and five years of smoothing?
I think most people smooth. I think smoothing is standard because it's hard to budget. If you're looking at that chart, you'd go crazy at the legislature if every year was up or down. And, I think you'd go crazy. I think it can help you from a legislative point of view if you know when you want to put extra money in. So if you're looking at, well, I have an extra 100 million, should I put it in now? Maybe that's goes into the equation a little bit more closely, but I don't know the answer to that.
Thank you.
It might be helpful for him to explain why and you started down the path, the smoothing is used because of budgeting, in that we get a number every year. And if the market is in a down year, we get that number plus an amount to make up for what we should have had.
And as you get closer to 2038, it's closer and closer and closer to the end date. So it gets, a bad year is even worse in over the next 18 years. So smoothing will basically take the past 5 years at 20% each, and it'll give you, that's your return from an actuarial point of view. Some people use 5 years, some people use 3, some people don't do any. But it gives you a number. Now, if you just use this year's rate of return, your number will be a lot smaller because you will have met your obligation and then some. Last year, when we were only 4% on our annual market rate of return, you would have been a little bit short. Was it 4% or 6% last year? The smooth number mirrors this, but it's just a little bit close, hugs the line a little bit closer.
Or comments or congratulations for getting us on track.
Well, I think we've done a lot of work, but
Yeah.
we're not done.
No.
And obviously, I'd like to see this problem solved, and it would be great to have I'd love to see an 85% funded plan within 5 years, but I don't know if you can set goals like that, or do you do short-term goals and long-term goals or something of that nature? It's difficult watching teachers dip down towards 50% because then it gets to that critical level where we really have to consider changing our asset allocation strategy to meet liquidity, and that would be troubling.
Can you talk a little more about that, especially if we hit a recession? I mean,
Well,
what that
our stopgap now is the legislature. We don't, that's ultimately we would have to go to you and say, we don't have the cash flow to meet these obligations. We'll either need to sell at the worst possible time or, cover it up with increased contributions to make up the difference. We're not at that level. We're nowhere near that level. But if you get to, you look at states that are 25% funded, look at Kentucky, they're basically pay as you go, and it gets to be similar to your OPEB number where you're fighting this impossible moving train that's constantly accruing liabilities, and you don't have the assets to cover it. And so it's hard to say, but it's decisions from 1979 and 82 and the 23 years or so that the state didn't fund the ARC. In teachers, it was about 150 million in total. And you think that's not that much, but that 150 million with these returns would have been about $1 billion. And so if you had $1 billion more because of those $2 million decisions 20 years ago, how would it look now? That's why you really have to look at the arc and strategically add more to it to pay down those mistakes from the past as quickly as you can. So I'd advocate really aggressively paying down whenever and wherever you can, and not try to time too much, but just understand that, you're fighting this moving train that isn't going to get easier over the next 5 to 10 years, unless you change benefits and change other features, which, can help slow it down.
I'd rather do the investing than solving.
You've just been recruited to this committee. You didn't know that?
I like being the investment side.
Well, we're always available, and if you need anything from BPIC, we'd be happy. And Eric Henry would be a great resource, and our actuaries are available for your use as well.
And it, probably goes without saying, but this is your money. And so, if you have questions or thoughts or if you find that there are other things that you'd like to understand more, please do take advantage of learning about the investment strategies that your money is for right now. Important part of the solution.
Yeah.
Any more questions or comments for Tom? Thank you so much, sir.
No, thanks anytime.
Thank you.
Thank you.
You still on the city council?
No, I dropped city council about 4 years. On for 12 years. Hard because there were night meetings. Anyway, thank you very much.
Thank you.
Thanks, son.
All right,
Committee.
folks.
Where are we?
We're at the end of our agenda.
Eric, you didn't turn in your thing yet.
I did not. I do have it over here.
Okay.
Thanks for the reminder.
I just wanted to mention that we do have room 10 secured in the State House for all of our upcoming meetings, everything that we've scheduled thus far.
Great.
Excellent.
Good. Thank you. Yeah.
No more bench, no more elevator. Great.
When do you think we can expect to see the next doodle poll for the remainder of the meetings?
That's a good question.
I will get it done by the end of the week.